All right, let's dive in. Today, we're going to tackle the stock market. It's this thing that can make people incredibly wealthy, but man, it's surrounded by all this confusing jargon, right? Our mission here is to just slice right through all that noise and give you the essential playbook. So, let's get to it.
And what better way to kick things off than with a quote from the legend himself, Warren Buffett. Seriously, read this. It just hits you, right? It perfectly nails the why of investing. It's not about watching numbers bounce around on a screen. It's about setting up a future where your money is out there working for you, even when you're sleeping.
I mean, let's be real. The second someone starts throwing around terms like PE ratios or market cap, your eyes probably start to glaze over. It feels like this secret language, this code you're not supposed to understand. But here's the thing, it's really not that complicated. The basic ideas behind it all, pretty straightforward actually.
And that's exactly what we're going to do here. I promise. In the next few minutes, we're going to crack that code. We're not just going to throw definitions at you. We're going to give you the frameworks, the actual ways to think about how the market works so you can figure out where you might fit in.
Okay, so before we jump into all the details of how it all works, let's just take one step back. Let's ask the most fundamental question there is, why? Why on earth should you take your hard-earned cash and put it into this thing called the stock market in the first place?
When you boil it all down, this is it. Investing is simply taking money that's just, sitting there doing nothing and putting it to work. Think of it like you're giving your money a job, and the whole point of that job is for it to come back with more money than it left with.
And that job we just gave our money, it's got some really important tasks. First, earning a return on those idle resources. Maybe you're trying to generate money for a specific goal, like a down payment on a house. And probably the most important one, making a provision for an uncertain future. It's all about building that financial security.
Now, one thing you got to know right away, the market is not a calm, straight line going up. Nope. It's more like a really moody creature. It has these wild swings. And understanding its two main moods, the super optimistic bull and the really grumpy bear, is like lesson number one.
So, a bull market, that's when everything's awesome. The economy's humming along, everyone feels good about the future, and stock prices are generally climbing. A bear market is, well, it's the total opposite. Pessimism takes over, the economy slows down, and prices start to fall, sometimes by a lot.
You can really think of it like these two superheroes, constantly locked in a fight. It's a non-stop tug of war. And it's not really about spreadsheets and numbers. It's about human psychology. You've got the bulls, fueled by optimism, trying to push everything up. And you've got the bears, driven by fear, trying to pull it all down. This battle happens every single day.
Ever wonder where those names even came from? It's actually super simple and kind of cool. Think about how a bull attacks. It thrusts its horns up. And a bear? It swipes its paws down. It's a perfect, simple metaphor for which way the market is moving.
And this is where it all connects back to, real life. A bull market isn't just good news for investors. It usually means the economy is strong. Companies are hiring people, and things are generally looking good. A bear market? Well, that can mean high unemployment and a shrinking economy. It's basically an economic weather report, and it affects all of us.
Okay, so now you get why you should invest, and you get the market's basic moods. Now you have to ask yourself, how do I want to play this game? Because there are really two totally different ways to approach it. You can be an investor, or you can be a trader.
Okay, this is my favorite way to think about it, especially if you're a cricket fan. Investing, that's like a test match. It's the long game. It's patient, strategic, and you're building something over years. Trading, that's a T20 match. It's fast, it's exciting, it's all about quick action and trying to score fast.
Let's really dig into this. First, the time horizon. It's the biggest difference, right? We're talking years, even decades for investing versus maybe just seconds or months for trading. That completely changes the goal. An investor is slowly, carefully creating wealth. A trader is trying to make quick profits off of those market swings. So naturally, trading is way riskier. And check this out. The analysis is totally different too. Investors use what's called fundamental analysis. They're like detectives, digging into a company's health. Traders? They use technical analysis. They're more like weather forecasters, looking at charts and patterns to predict the next short-term move.
So no matter which game you decide to play, the test match or the T20, you've got to know what you're buying. How do you figure out how big a company is? or if its stock price is, even fair. Let's look at the scorecard.
First thing you need to know is market cap. It sounds fancy, but it's just the total price tag of a company on the stock market. All you do is take the number of shares out there and multiply it by the price of one share. Boom! That's its market cap. It's the quickest way to get a sense of a company's size.
And we use this market cap number to basically sort companies into different sizes. You've got your large caps. These are the huge, established companies. Think of them as the big, stable battleships of the market. Then you have mid caps, which are in their growth phase, and small caps, which are like little speedboats. They're riskier, for sure, but they have the potential to grow incredibly fast.
Okay, next up is the PE ratio, the price-to-earnings ratio. All this does is help you figure out if a stock is cheap or expensive compared to the profits the company is actually making. It helps you answer one simple question. Am I getting a good deal here for this stock?
So if you see a company with a high PE, it means investors are really optimistic. They have super high expectations for the future. They're willing to pay a lot today because they think it's going to earn a ton of money tomorrow. On the flip side, a low PE might mean investors are overlooking it. It could be a hidden gem, a potential bargain. Now, one isn't automatically better than the other. They just tell two different stories about what the market is thinking.
Okay, so far we've been all about offense, how to score points, how to grow your money. But you know what they say? Defense wins championships. So now we absolutely have to talk about how you protect your money. How do you play defense?
Because this is the big one, isn't it? The question that keeps people up at night. What if I lose my money? And look, that's a valid fear. Investing has risks. The market goes down too. You can't just ignore risk and hope for the best. You have to manage it. That is the whole game.
So how do we do that? Here are 4 key defensive moves. Step 1, diversify. You've heard this a million times, don't put all your eggs in one basket. It's true. Spread your money out. Step 2, position sizing. This is simple. It just means you don't go all in on one risky stock. You limit your exposure. Step 3, use a stop-loss order. This is a fantastic tool. It's like an automatic eject button. You tell your broker, hey, if this stock falls to this price, sell it for me. And 4th, and this is maybe the hardest one, stay focused on your long-term goals. Don't panic when the market has a bad day.
And this brings us back to Warren Buffett for his most famous piece of advice. Rule number 1, don't lose money. Rule number 2, never forget rule number 1. It sounds almost too simple, but it's everything. Because if you lose a big chunk of your money, you need a huge gain just to get back to even. Protecting what you have is the absolute foundation.
So there you have it. We've gone through the market's moods, the different games you can play, how to read the scorecard, and how to play defense. The jargon, it isn't so scary anymore, is it? You've got the basics down. So the real question I want to leave you with isn't about the market. It's about you. Now that you know the rules of the game, what kind of player are you going to be?